Welcome, everyone, to Beyond Stripe, the next era of global payments infrastructure. Stripe transformed fintech by making payments simple, an API revolution that powered millions of businesses. But as we've seen over the last decade, payments, identity, and compliance are no longer isolated challenges. They're converging into one global infrastructure.
Exactly. The future isn't about a single platform controlling the rails. It's about interoperable layers of trust. We're moving from digital convenience to digital resilience, where networks can adapt, survive outages, and meet regulation dynamically.
And that's what investors are watching closely. Who's building the infrastructure that powers tomorrow's financial internet?
Before we talk about what comes next, it's important to say this clearly. Stripe didn't win by accident. It solved the hardest problem at the time, making internet payments actually work for developers. Speed mattered more than resilience. Abstraction mattered more than redundancy. And for a decade, that trade-off made total sense. What changed isn't Stripe. What changed is scale. Global scale, regulatory scale, and dependency scale. Every infrastructure era starts simple. The pressure only shows up later.
From an investor perspective, centralization is efficient until it isn't. The problem isn't a single outage. It's correlated failure when millions of transactions, merchants, and jurisdictions depend on the same underlying assumptions. At scale, small operational issues turn into systemic risk, and markets always reprice systemic risk. This is where infrastructure stops being a technical decision and becomes a capital one.
So let's talk about what's really changed. Why we say the era of easy payments is over.
When Stripe entered, it democratized payments. Anyone could start selling online in minutes. But it also created a dependence on a single processor model. That centralization became both a superpower and a weakness. One outage, one compliance block, and the system halts.
When we look across fintech over the last few years, the cracks didn't show up all at once. APIs failed before business models did. Compliance bottlenecks surfaced before revenue slowed, and cross-border friction appeared long before customers churned. These weren't edge cases. They were early warning signals. Signals that the stack itself needed to evolve.
A common reaction is, we'll just add redundancy. Another processor, another vendor, another integration. But redundancy without orchestration just adds complexity. If identity is still centralized, compliance is still manual, and routing is still static, you haven't removed fragility. You've just spread it around. Real resilience requires coordination, not duplication.
Exactly. We saw this vividly in global fintech markets. Companies that relied on one provider faced latency, downtime, or compliance shutdowns in multiple regions. Investors are now prioritizing redundancy, not just efficiency. This is where the model fundamentally shifts. Identity stops being something you check once and becomes something you carry. Compliance moves from batch reviews to continuous logic, and routing becomes adaptive, not fixed. The system responds to stress instead of breaking under it. That's the difference between infrastructure that scales and infrastructure that survives.
So, what replaces fragile systems? The answer: trust infrastructure.
We're seeing a shift from payment gateways to trust frameworks. These integrate identity verification, compliance automation, and transaction validation into a single resilient layer. It's not about just moving money, it's about proving trust at every hop. Trust used to be abstract. Now it's engineered. Identity is infrastructure. Compliance is executable logic. Risk is programmable. When trust becomes technical, it can scale globally and consistently. That's the shift we're living through right now. This is what modern payments infrastructure actually looks like under the hood. Identity sits at the foundation, portable, reusable, and jurisdiction aware. Compliance orchestrates continuously across transactions. Payments route dynamically, and auditability is built in, not bolted on. Each layer strengthens the others. This is how you design for growth and regulation at the same time.
Platforms scale until they hit regulatory or operational ceilings. Frameworks scale because they're modular. They adapt to jurisdictions instead of fighting them. And they dramatically reduce systemic blast radius. From an investment lens, this is how you build durability, not just growth. And from an investor perspective, that's key. The most valuable fintechs of this decade won't be the ones with the most users. They'll be the ones with the strongest uptime, fastest KYC, and clearest compliance record.
Jean-Marc, let's dig deeper. Where is investor capital moving now?
The next fintech frontier isn't consumer apps, it's infrastructure. Investors are tracking the players that can deliver three things: redundancy, compliance automation, and interoperability. If your system can keep running during an outage or regulatory update, you win. It's that simple.
We've seen this shift firsthand. The conversation isn't who's the fastest, it's who's the most resilient. That's why infrastructure is the new moat.
Valuation models are changing. GMV matters, but uptime-adjusted volume matters more. Customer acquisition matters, but automated compliance rates matter more. Geographic reach is no longer about how many countries you serve. It's about how seamlessly you interoperate across them. These metrics signal infrastructure maturity and future multiples. The best investors don't wait for revenue to stall. They look for architectural signals, multi-cloud design, incident transparency, regulatory response time. These don't trend on social media, but they compound quietly, and over time, they separate durable platforms from fragile ones.
Before we wrap, let's summarize the key shifts shaping global payments.
First, resilience. Systems must survive failures and adapt in real time. Second, regulation. Compliance can't be an afterthought, it must live in the rails. Third, reach. The new infrastructure must bridge currencies, geographies, and ecosystems.
For investors, those three R's are the North Star. They tell you which companies are building not just apps, but the backbone of the global financial internet.
What's winning capital right now isn't apps. It's connective tissue, identity-first infrastructure, compliance orchestration, cross-network connectors. These are not consumer brands, they're system enablers, and every financial platform eventually depends on them.
Regulation doesn't disappear, it compounds. Trust layers are sticky. Switching costs move upstream, and infrastructure adoption happens once, but lasts decades. That's why this category attracts patient capital. It's not about speed anymore. It's about staying power.
Platforms compete on features. Frameworks endure through cycles. As payments evolve into protocols, trust becomes the real moat. And the systems that connect are the ones that survive. What we've learned today is simple. The fintech revolution isn't over. It's just gone underground. While consumer apps get the spotlight, The real innovation is happening behind the rails. Thanks for joining us today. If you'd like to explore this further, you can download our PDF guide, The Future of Payments Infrastructure, 2025 Outlook.
We built this as a resource for operators, founders, and investors who want to understand where the rails are heading next, beyond Stripe, beyond today's models.
And remember, the question isn't which platform dominates, it's which networks endure. That's the foundation of the next era of finance.
Before we open it up, quick pulse check. In your stack today, what's under the most pressure? Payments, compliance, or identity? Drop it in the chat. Let's compare notes. Now let's open it up for questions from our attendees. Feel free to type your questions in the chat and we'll answer as many as we can. Gina, our first question is Stripe actually at risk or is it just evolution?
Well, that's a great question. As one we hear often, Stripe isn't at risk. It's defined an era, but that era optimized developer speed and API simplicity. They were the first. What we're entering now is an era optimized by resilience and compliance continuity. That requires multi-layer trust architecture, not just a gateway.
And I'd say as investors, we don't view it as a disruption. It's a stack evolution. Every major infrastructure wave builds on the last.
So you're not saying Stripe is obsolete?
Not obsolete, foundational. Every era builds on the last. What we're describing is a layer being built on top.
Why can't Stripe or Aiden just build this themselves? Gina?
They can add features, and they will, but structurally redesign is harder than feature integration. To give you an example, Chase funded NMI several $million, and they couldn't redo what they had already. They couldn't add to it because the code was so old. And so that's what some of these companies are facing. When your architecture was built around central routing, shifting to multi-layer distribution trust takes time and trade-offs and reprogramming.
What does trust infrastructure really look like?
It means embedding identity, compliance, and redundancy directly into transaction flow, not layering them on afterwards. Think of it as moving from approve, then audit to verify continuously.
And Jean-Marc, do you have anything to add?
So instead of trust being a checkpoint, it becomes a persistent property.
Isn't compliance always going to slow things down?
Manual compliance slows things down. Programmable compliance accelerates things. After speaking with many other payment processors, none of them have this built in to automate. If compliance logic lives in the infrastructure layer, verification happens automatically and continuously.
So how do you measure infrastructure resilience, Gina?
We look at multi-processor redundancy, uptime SLAs, real-time audit capabilities, cross-border compliance coverage, recovery time objectives. Volume processed is no longer the sole metric.
And Jean-Marc?
And importantly, how quickly systems adapt when regulation changes.
What role does decentralization play in this?
Decentralization isn't about removing banks. It's about removing single points of failure. Distributed routing, multi-cloud design, and cross-ledger validation are resilient tools.
So decentralization becomes infrastructure logic, not ideology.
Jean-Marc, where is capital flowing right now?
We're seeing capital shifts toward RegTech infrastructure, identity frameworks, cross-border routing platforms, multi-cloud infrastructure plays. Probably the most sophisticated funds are going deeper into back-end rails.
What is the biggest risk in payments infrastructure today? Gina?
Concentration risk, cloud concentration, processor concentration, jurisdiction concentration.
And Jean-Marc?
I would add regulatory lag. Companies that can't adapt quickly will struggle.
So how do you two see payments in 5 years?
I think they're going to look less centralized, more modular, more compliance automated, and evaluated by resilience, not just speed.
And I would say there's a huge shift towards trust being programmable.
What actually changes in payments 2.0?
The core shift is from speed to resilience. Payments 1.0 optimized for developer convenience. Payments 2.0 optimizes for uptime, regulatory adaptability, and cross-border continuity.
What's the biggest hidden risk in fintech today, Gina?
Concentration risk. One processor, one cloud, one compliance tax. When one fails, everything fails.
Jean-Marc, what metric matters most now?
I think uptime under stress, not just average uptime, resilience during outages and regulatory shifts.
Is compliance always a drag on growth?
Manual compliance is, programmable compliance isn't. When compliance logic is embedded in infrastructure, it accelerates expansion instead of slowing it down. If I can elaborate, well, can I elaborate on that? So what happens is when you submit an application, we have to go out through all the KYCs, but with us, it instantly goes in and pulls all of those without a human having to type it in, look at it, and see what needs to happen. It's automated with AI. And so only after all of it is done and comes back to a human's desk. So it takes out about 5 steps.
Before the humans monitor it.
Correct.
What's LockTrust's structural edge? Jean-Marc?
I think the unified identity and payment architecture. We have 170 plus integrations and multi-jurisdictional compliance built into routing, not layered on top.
Gina, what replaces the single platform model?
Modular trust architecture. Entity layer, compliance layer, routing layer, settlement layer, interoperable, redundant, programmable.
So if the API era is democratized payments, the trust era will be institutionalizing them. And that's where the next decade of value creation lives. Thank you, everybody.